Start the webinar.
So we are live now.
Yeah, we are online.
Good morning, all dear friends, members, guests, and all our teachers. Welcome to today's event on virtual CPE meeting on Synoptic overview of IFRS 17, Teachers' Day celebration, and inauguration of the job portal for which the Muscat chapter team has been working on for a long time. Today we are joined by our chief guest, Dr. Zahran Al-Saiti. Guest of honor is our beloved CA, Dr. S.B. Zaure. And to speak on the technical topic, we have speaker CA James Ravi and Dr. Alok Kumar Agarwal. So I welcome everybody to this technical session as well as the celebration of the Teachers' Day. So I request our chairman CA Ravi Devra to deliver the welcome address.
Thank you, Unmesh. Respected Chief Guest, Dr. Zahran Al-Saiti, Dean, College of Banking and Financial Studies, S.B. Zaure sir, leaders and members, wish you all a very happy Teachers' Day. On this auspicious occasion, we have great teachers with us. Dr. Zahran Al-Saiti himself, he was a teacher in Sultan Qaboos University, and now he's a dean in the College of Banking and Financial Studies. And CA S.B. Zaure sir, who have many of our Muscat students also was a teacher, student of the S.B. Zaure sir, including two of our MC members and past chairman Mubin Khan and Unmesh. And many of us S.B. Zaure sir is a renowned name. And all of the efforts and hard work you have invested to bring out the best in us, and never all of the efforts and hard work you have invested to bring out the best in us can never be repaid by mere words. We can only feel grateful to you for having your teachers like you. Thank you, sir, and our heartful tribute to you. And today's day is further become memorable as we are launching the job portal page for the benefit of our members in our website by our chief guest, Dr. Zahran Al-Saiti. This website will enable our members to share with us any job openings in Oman for our members. Our members can frequently visit the website and take the benefit of the opportunities available. This service is exclusively for our members and is complimentary as part of membership benefit. We thank our MC member, CA Digan Pandya, and our website developer, Mr. Uttam, for developing this in a short notice. In today's event, we have two renowned speakers from Messrs. Crow, Dr. Alok Kumar Agarwal and CA James Ravi, who will take us through IFRS 17 on insurance contract, which is a replacement of IFRS 4, and enlighten us on the treatment of various contracts items in the financial statements, including measurement and disclosures. Without taking much of your time, I once again welcome you all on today's session. Happy Teachers' Day and happy learning. Thank you.
Thank you, Raviji, for the opening remarks. Now I request CA Jim to introduce our chief guest, Dr. Zahran Al-Saiti.
Thank you, Unmesh. I'm so happy to introduce Dr. Zahran Al-Saiti, the Dean of College of Banking and Financial Studies, our sponsors. Dr. Al-Saiti has more than 23 years administrative and academic experience, both in government sector and private sector. Dr. Saiti started his career with Ministry of Higher Education, Scientific Research and Innovation, where he held a number of technical and administrative positions, the last of which was Director of Postgraduate Studies at the Director General of Scholarships. 2004, he moved to Sultan Qaboos University as a faculty member of the College of Economic and Political Science, and later he served as Director of the Center of Community Service and Continuing Education. Dr. Zahran holds a bachelor degree from United States of America, master's and doctorate degrees from UK. On behalf of ICA Muscat chapter and all those who virtually gathered here, I would like to welcome Dr. Zahran and request you to address the gathering. Please, sir.
All right. Thank you very much. Thank you for the kind introduction. I don't have a structured speech. However, first of all, allow me to warmly thank you all for the kind invitation to this webinar. It's an honor and it's a pleasure. As you may know that I have just joined CBFS. It has been only 20 days. I just completed 20 days. I joined on the 15th of August. But I would like to assure you that the college is proud to host ICAI, the Muscat chapter, and will continue to support. And I am personally keen to expand this partnership. I get to know from my colleagues that the chapter has been very active since it's been established in 2008. And I definitely am looking forward to meeting the chairperson of the chapter, Sia Ravi Diora, to discuss any further initiatives of mutual interest. Thank you once again, and I wish you all a fruitful webinar and also happy Teacher Day. Thank you very much.
Thank you, Dr.
Thank you.
Zaran, for those kind words, and looking forward to have a further strengthening relationship with CBFS.
Sure.
Okay, now moving on to the next topic. Like teachers are the pillars of the country. They guide and shape the destiny of the students and thereby the destiny of the nation and the society. They teach them to become better human beings. They are the reason behind the success of the mankind. Teachers like Dronacharya, Sri Parshuram from the Indian ancient history, the scholars from the recent history like Chanakya and Swami Ramdas, whose writings in Dasbodh are still taught in the management books, to modern day teachers like Sarvapalli Radhakrishnan and Dr. APJ Kalam are some of the renowned names that give real meaning and value to the word teacher. Today, we are privileged to have CA SB Zaure as our guest of honor. So I request Sangeeta ji to please introduce Zaure sir.
Thank you, Unmesh. On this special occasion of Teachers' Day celebration, I feel it's my privilege to have got this opportunity to welcome and introduce Zaure sir, a person who needs no introduction among the CA members and students fraternity. Zaure sir is a name which is well known worldwide, especially those who hail from Pune. They would have started the CA career with the blessings and knowledge spread by Zaure sir, attending his coaching classes, Zaure Professional Academy, which has been in existence for more than 40 years and has been imparting training for more than 10,000 students. And I would just introduce him from the professional and academic perspective. He is a fellow member of ICAI since 1973. He is a PhD holder from Savitribai Phule, Pune University, former Central Council member of ICAI, former chairman of Accounting Standards Boards of ICAI, current chairman of Asian Oceanian Standard Setters Group for 2019 to 2021, present member of Accounting Standards of Advisory Forum of International Accounting Standard Board of IFRS Foundation, London for 2018 to 2021. He has received Lifetime Achievement Award for contribution to the fields of chartered accountancy, education, administration, and social work conferred by Maharashtra Cosmopolitan Education Society and Alana Institute of Management Sciences, Pune. And from the professional contribution perspective, he has contributed to many national and international conferences, seminars, and meetings. He has been ICAI faculty of IFRS for many years, and he has been a visionary and pioneer faculty in CA profession, a mentor to the core faculty of his academy. And from his contribution to the society, he is the founder president of Gargundi Education Development Society in Ahmednagar district, a society which is helping hand for hand for economically weak but talented students. Contributed various articles on professional and social note in many newspapers and periodicals. And with this, I extend a warm welcome to you, sir. Request you to kindly address our audience today. Over to you, sir. Thank you.
Thank you, Sangeeta, for your kind words of introduction. And I'm happy to meet you all. Chief guest for today's CPE program, Dr. Jairan Salti, the Dean of the College of Banking and Financial Studies, learned speakers, to whom I know CA James Ravi, now the director in Crow, Dr. Alok Kumar Agarwal, my dear student friends here, and the renowned chartered accountants in Muscat, CA Ravi Devra, the current chairman, past chairman Mubin Khan, Unmesh Bhume, and all other office bearers of the Muscat chapter of ICAI. On my behalf and behalf of my academy, I'm happy to be a keynote speaker for today's CPA program of the Muscat chapter. When Ravi Devra, couple of months ago, told me that you have to participate in the program of Muscat, and I said, all right, absolutely no problem. I was a little bit busy, but I could find out a time for all of you. I had been to Muscat chapter, and I received the warm welcome by Mubin Khan and his team earlier. And I just told him that after this corona is over, let me see if I can come to the Muscat physically and let us have the interaction with each other. I'm happy because I told C. Ravi that the Teachers' Day is 5th September. Then why you are calling on 4th September? And then he said, sir, one day earlier is better rather than later. The 5th September is recognized as a Teachers' Day, as a birthday of our great president, a teacher who elevated to the post of a Honorable President of India, Dr. Radha Krishnan Sarvapalli, who was born on this day and elevated from teacher to the president. And thanks to all of you for giving me an opportunity to talk about as a keynote, give the keynote address to all of you. So nice of you. I always remember the teacher job is good seed sown always yields best plant and the tasty fruits that I'm enjoying today. And I'm proud of you all working for the betterment of the profession. My dear friends, I'm in the profession for the last 48 years. And I've seen the entire change, sea change, starting from manual accounting till now. I have recently composed one poem on a chartered accountant. I will send to Ravi Devra. He will circulate to all the members rather than taking the time of our education program.
It's in our newsletter, sir.
Yes, absolutely. I'll send you. I'm so happy that you have kept a topic of IFRS 17 insurance contract for today's deliberations. Because in Asian Oceanian Standard Setter Group and the IASB, that is International Accounting Standard Board, we had number of deliberations on this topic because this particular standard required 20 years to make. When it was concept was evolved, and when the standard is coming into the picture, it almost required 20 years, that is maximum time. And the astonishing to me, because when I'm teaching the topic of insurance for the general insurance company, life insurance company, the problem was how to make a provision for unexpired risk. And you are aware in India, with a guideline by the regulator, that is IRDA, they stated earlier, even today, that as far as fire and general insurance is concerned, you make a provision for reserve for unexpired risk equal to 50% of the net premium. And in case of marine, 100% of the net premium. The students like Mubin Khan or Unmesh asked me a question, sir, why, from where you have brought 50% and 100%? And it was nothing but estimation. It was not true and fair. And I always thought that this provision for unexpired risk is not calculated scientifically. Answer was only one, that we are following consistency and we are following the precedence of our earlier generation, but which was not right. It was untrue and unfair. It was rule-based guidance, but the problem is now solved with reference to IFRS 17, that is insurance contract, because this is a solution to the problem and the replacement of IFRS 4, which are not followed in India. This particular standard is applicable from 1st January 2023 worldwide. India is yet to decide the date of implementation. We are talking with the Ministry of Corporate Affairs along with the IRDA officials, but so far the date is not yet finalized. Number of times there is a confusion whether this IFRS 17 is applicable only to insurance companies. And my dear participants, the answer is no. This standard is applicable for insurance contract. So there may be non-insurance companies, but who have given assurance on happening of a certain event, even for these corporates or even for these companies, this particular IFRS 17, and in India we call as AS 17, 117. The problem in earlier accounting was investment contracts were merged with insurance contracts and the treatment was given the same, especially with discretionary participant features. But now, with IFRS 9, that is financial instruments, and IFRS 17, all these issues are resolved with qualitative guidance and implementation. That is very important. The issuers of insurance contract should report them the statement of financial position with reference to fulfillment of cash flows, being current estimate of amount that entity expects to collect the premium and pay out the claims, benefits and expenses adjusted to the timings and risk. That is very important. All of you are aware the timing factor is very important for all the IFRS, and there is a sea change as far as accounting is concerned. With the concept of contractual service margin being the expected profit for providing insurance cover has been inbuilt in IFRS 17. The contract with expected profit is recognized over the insurance contract period. However, in case if the contract is onerous and if the loss is expected, you are aware about the concept of prudence or the concept of conservatism. It is required to provide the loss immediately. You have to remeasure at each reporting date with current discount rate and estimates of the amount, timings and uncertainty of the cash flows. The change in carrying amount of insurance contract is included with reference to adopted accounting policy either in statement of profit or loss or in OCI, that is other comprehensive income. However, the standard also provides if there is a short-term insurance contract, you can follow, you have a choice to follow, it is optional that you can allocate the premium with available measure. Simplified accounting for short-term insurance contracts. However, this was the system earlier, as I told you in the beginning. The standard also has extensive disclosure requirement, robust disclosure requirement, because IFRS are followed worldwide for public interest entities, and therefore there has to be robust disclosures. International Accounting Standard Board published exposure draft application of IFRS 17 and IFRS 9, comparative information with narrow scope amendments on 20th July 2021, and still we have a comment period up to 30th September 2021. IASB has also issued the amendments to IFRS 17 insurance contracts to help companies with implementations. That is very important because this standard is most complicated standard, I tell you. Big change for insurance companies, especially for data administration, financial presentation, and actuarial calculations. This is very, very important. Because in India, when I was a chairman of the Accounting Standard Board and I had deliberations with insurance companies, I was not facing much problem as far as general insurance companies are concerned. However, especially Life Insurance Corporation of India, tremendous pressure and delay in implementation of the new one, because there is a lot of impact after this standard on reporting, the entire organizational structure, and in particular IT system. And when you are going to transit from old accounting to new accounting, new financial reporting, there is a sea change as far as IFRS 17 is concerned with reference to the fair value, with reference to time value of money, and with reference to not a rule-based application, but principle-based standard. Asian Oceanian Standard Setter Group of 27 jurisdictions, of which I am a chair as at present, we have taken number of education sessions. This is a group of the regulators. This is not a group of professionals. For example, in Japanese, they are the regulators in Japan, Australia, New Zealand, up to Iraq, Iran. And this particular group is helping a lot to the IASB in the pre and post implementation stages for making necessary changes. And thanks to ICAI for nominating me as a vice chair in 2017, and I have taken a charge from China, and now I am a chair. We have a number of opportunities to deliberate on this particular standard for IFRS 17. I know James Ravi in particular, because when he was in ICI in Dubai, and he is a faculty for the IFRS certificate courses, and you have rightly chosen the person who will give you the complete idea, as well as Dr. Agarwal. So I am really thankful today to the chairman in particular, C. Ravi Devra, and all other committee members for giving me an opportunity to deliver keynote address on IFRS 17, a new standard to educate the professionals. May I take this opportunity to wish you to add to your prosperity, subtract your worries, multiply your happiness, and divide your problems with equal number of solutions. Thanks for giving me an opportunity on the eve of a Teacher's Day, and all my blessings for good work, and all the best for the today's CPE program. Thank you. I am proud of you all.
It's blessings for us, sir. Thank you, sir.
Thank you, sir. Thank you for those kind words and highlighting the key aspects of the IFRS 17, which is going to change the entire accounting for all the insurance contracts. It's one of the most technical and I would say the difficult standard so far. And that's why it took around 20 years for it to come out. So thank you for the for addressing the gathering. Now I request favorite student Bin Khan to take over the session for the Teachers' Day celebration.
Thank you, Unmesh. I think it would not have been a perfect Teachers' Day Eve without presence of our guru, CSB Zavre ji.
True.
I will just take 2-3 minutes, what Teachers Day and what teacher means to me. And I'll just share with you. Even if you see, in our religious scriptures, like Nabi Muhammad Sallallahu Alaihi Wasallam, the very first message that he received from Almighty, it is in Quran, Surah Alaq. So the very first revelation that he received was Ikra. Ikra bismi rabbika allazi khalaq khalaqal insan min alaq. Ikra aw rabbuka al-ikram allazi allama min qalam. So the first revelation was not Isma, it was Ikra, read. So education is so important, in our life, that even you read, you pick up any religious scriptures, and you will find this. When I was the chairman of CA chapter, and definitely the international conference under my chairmanship, I invited my guru. So CSB Zavre Sahab, he was very busy, and I had really had to use the Vasta. I spoke to Amarji Chopra ji also. I said, you have to bring him. Without him, no international conference. So when I went on the stage, so I touched his feet. So with me were my Omani colleagues from Capital Market Authorities. In Capital Market Authority building, if you enter, and if you ask about me, Mubin, so I'm there like teacher. So like everybody will say, he's our teacher. So in my cabin, you will find right from when I enter till 3 o'clock, my Omani friends, they will come. There is a board there. Whatever query or question, the classroom will start there. So when these Omani colleagues, they were there, they said, Mubin, tell me what you did when you went on the stage and you bow down to him and you touched his feet. I said, let me explain to you what place a teacher has in our life. I told them, in religious terms, he said, Allah says, we pray to Allah, Wakul Rabbi Zidni Ilma. That I want to increase my knowledge. You can never become more knowledgeable than your teacher. And this gesture of touching the feet of the teacher is the complete surrender from a student to the teacher. I am your teacher. I am in Capital Market Authority building, you call me your teacher, teacher of everybody. And you saw teacher of your teacher. So this is how I explained to them, and they were amazed. They said, I said, always remember, Dr. Zahran was talking about his teacher so proudly. Now his student is CFO in such a big company. Dr. Zahran is the happiest teacher to see his student occupying such a big position, and look at the humbleness of the student. He is telling Ravi Devara that he is my teacher. So teacher is always the teacher. That is why in Indian scripture it says, Guru Brahma, Guru Vishnu, Guru Devo Maheshwara, Guru Sakshat Param Brahma, Tasmai Guruve Namah. Tasmai Guruve Namah. Yani, this is how, we are taught. Unmesh Bhumeji was talking about Achar Chanakya. Achar Chanakya, if you read, I am avid reader of Achar Chanakya's Niti Shastra. So there is one shlok, Savidyanam ko Videsha. So Acharya Chanakya said, a person who is educated, for him, no land is an alien land. Look at us. We are far away from our land, but still we are able to live our livelihood. And Acharya Chanakya says, Yeshana Videna Tapona Dhyanam Jnanam Nashilam na Guruna Dharma Te Mirtai Loke Bhuvi Bhara Bhuta Manushya Rupen Mirkash Charanti. Yani, the person who is not having education, the person who is not humble, the person who has not done good things for other people, this person on this earth is like animal. He is like a human. He is human, Actually, he's an animal who is walking around like a human. So you go to any religious scripture, you go to any writings. Two things are very important. Two things. Number one is the education, and number two, the teacher. And when it comes to teacher, let me tell you, when I traveled, I was not passing CA examination. I was trying. Something was missing. I needed a group. Then I went to my group, taking a journey of more than 10 hours. I reached Pune. And my friends, the railway ticket that I had purchased, and let me tell you, I reached Pune within 4 months after attending the class. It's not only classes, it's the guidance, the blessings. I passed two groups, and I thought, now this is what I wanted. I needed a group. That railway ticket, the journey that I took in 1999, 22 years back, my friends, I keep it as, you can say, a relic with me. When he came here, my teacher, CSB Zavreji, I showed him the ticket and he was amazed. He said, don't tell me that for 20 years you are keeping this ticket with you. I said, sir, this is what you mean to me. So what I will say on Teachers' Day, the role of teacher is very important. The very first teacher in our life is our mother. And definitely mother is the first teacher. And after that, if you ask me, if I we should always remember our guru. We should always keep learning, and we should always, we will always be the student. So this is what, thanks Onmesh for giving me an opportunity to express my gratitude to my teacher, and also to talk about the knowledge and the teacher. Thank you very much.
Mubin, I'll just interfere for just 2 minutes. Unmesh,
Yes, sir.
you
Yes, sir.
talked about perfection. In 1978, all of you are aware that I have evolved the mantra of success, and that is perfect. What that perfect mean? I pray Almighty, if I become perfect unto the end of life, I'm grateful. So the perfect is first P stands for professionalism. Many things are hidden. I don't want to expand today. E is effectiveness. R is regularity. F is firmness. Whatever I do it firmly when it is possible, when I have a pre-preparation, when I have a complete study, when I go into the insight of the subject. Firmness. Next, E is self-evaluation, my SWOT analysis. You may not believe I have completed 71. And even today, still there are some weaknesses which we are trying to improve. So understand your strength, understand your weakness, convert weakness into strength, find out the opportunities and find out the threats. That is self-evaluation. C is my conduct, my do's and my don'ts, my principles, what I should do, what I should not do. And last T is very important, time consciousness. I have to keep in mind time, value of money as a professional, and that T is time consciousness. So this perfect formula is the mantra of success. I request all my professional colleagues to try for perfection, and that is the mantra of success. Anyway, that is one. And moving, I was very keen that during my chairmanship of AOSSG, Asian Oceanian Standard Setter Group, I really want Oman to be the Oman regulator naturally, to be the member of AOSSG. And you are aware we are trying for that still.
Yes, sir. Yes, sir.
Even if it is not completed, I have the meeting in September, I have meeting in November. It will be possible. Please try to pursue them, because there is nothing harm. On the contrary, the authority, the regulator in Oman will be able to get updation as far as IFRS are concerned and the accounting knowledge is concerned, which they have to pass on to other stakeholders. Anyway, thank you for that. Please
Yes, sir.
continue.
After now the airport is open, sir. I was planning that you come here again to bless us, and then I will arrange your meeting with the executive president of Capital Market Authority and Central Bank of Oman.
Okay.
So that Corona was something, sir, that was stopping.
Yes, no problem. Thank you. I understand. Appreciate.
Thank you, Mubinji, for sharing those insights, and obviously Zavre sir for sharing the mantra again of the perfect. And we expect and we encourage all the professionals to follow this mantra and then take the profession to the newer heights. Okay, thank you, everybody. And now moving on to the next session is the most awaited inauguration of the job portal. So I request CA Digan Pandya to share the screen, and I request Dr. Zaran Salti to do the inauguration of the job portal.
So you want me to share the screen?
Yeah, so
Yes, Digan. Dr. Jairan,
Dr. Zaran,
Yes.
you need
please
to
say
say
a few
online.
words about. Please say a few words about job portal. We are having a job portal to be starting. This is job opportunities. So you need to inaugurate that with your click. With your kind words, we'll click that link.
All right. Do I have to click anything here or just say
Sir, I have opened it for you, sir. Basically, this is our website.
All right, great.
Yeah.
So we click, yeah. So you can say that we please go ahead and we can click.
Yeah. Go ahead. Thank you very much. First of all, I appreciate this effort to launch this job portal. I think it's a very good opportunities, for all people who will benefit from this portal, and we look forward to people start utilizing the portal and make benefit from it. Thank you very much. Go ahead.
Thank you, Doctor. Thank you, Dr. Zaran. So, Unmesh bhai, can I take 2 minutes just to for everybody's benefit?
Yes, please, Digan bhai.
Yeah. Good morning, everyone. And on behalf of Muscat chapter, I'll just introduce this new facility on our website. So we have developed the job portal where there is a 2 options. One is for the submit a vacancies. So anybody will be able to advertise their job openings on this portal. It is actually, it is an additional facility we are providing to our members to find a suitable job. So this is the, tab for submitting the vacancy. So this is very short, screen, and it will not take much of time, and you can, there are terms and conditions. Then, the job poster or the company can submit this. It will come to us and we will approve it. And as a members of the institute can go to this particular job opportunities page, and all the opportunities will be listed here. This will be exclusively for the members, paid members, and those are active members of the Institute of Chartered Accountants of India, Muscat chapter. And we would like to, on this occasion of Teachers' Day, we would like to open this facility for all. Thank you, thank you. And I think the credit goes to CA Ravi Devaraji, our chairman, vice chairman, our team, and all the members of MC and all the members who have supported us. Thank you so much.
Thank you, Digan bhai. So nice of you to pass on the credit to all of all the team members. But let me mention that Digan has spent a lot of time and efforts on getting this thing done. So thank you, Digan, once again.
Thank you
for the great effort for the benefit of all the members. Okay, now moving on to the now technical sessions. As Zavre sir explained, IFRS 17, it took almost 20 years from 1997 to 2017. So the interim standard, the IFRS 4, was issued in the year 2004, which to be very honest, had no real guidance as such. And it was left to be completely up to the companies and how they go about implementing and continuing the accounting and the disclosures, the presentation of the financial statements. So IFRS 17 would be playing a very significant role, and to guide all the members today, we have CA James Ravi and Dr. Alok Kumar Agarwal will be taking us through the technical session. So So I request now CA Digan Pandya to introduce our first speaker, CA Alok Kumar, Dr. Alok Kumar Agarwal.
Thank you, Unmesh. On behalf of Muscat chapter, I would like to welcome Dr. Alok Kumar Agarwal for delivering this session today. Dr. Agarwal has rich global experience in banking, financial services, and consulting. His experiences range from strategic management, corporate governance to financial risk management and internal audit and beyond. He leads the banking and financial services practice, enabling clients to resolve challenges, improve performance, and deliver growth. He is a certified fraud examiner, has a CRMS certification in risk management assurance, and CAMS certified anti-money laundering specialist from ACAMS USA. Dr. Alok Kumar Agarwal, we welcome you, sir, and over to you, sir.
Good morning, everyone, and thank you so very much, all of you at ICAI Oman, for inviting me to the event. It's really a pleasure to be with you today on occasion of Teachers' Day. And I'll bring up the screen and we'll take you through the technical session on IFRS 17. Just kindly give me a minute. I hope the screen is visible.
Yes, sir, it's visible.
Yes, sir. It's visible. Yeah.
1 minute. Yeah. 1 second. Maybe the slide is not moving. Just kindly hold. Yeah. Yeah. So talking about myself, I lead the financial services practice at Crow in UAE. And I have in the past conducted sessions on IFRS 17 with ACCA as well and Lloyd's of London. And today it's a very good opportunity for me to present this to all of you. And should there be any queries, I request you to put them in the chat box. And depending on the time, we'll do our best to come back to you, maybe subsequently if time doesn't permit today. So without further ado, I go straight into one of the most disruptive challenges in the insurance sector so far. IFRS 17 has been a game-changing accounting standard, if I may put it that way, and it will result in vast accounting change insurance industry ever envisioned. So having said that, let me tell you what are the learning objectives for today's session. It is basically a synoptic overview, and this will possibly help to improve awareness with this overview and also briefly gain some insight into the implementation challenges towards the end. And we will be holding this session in two parts. The first part, I'll be covering quite a lot of items, which we will go through now in the subsequent slides. And then my CA James Ravi, he will be taking over from me and he will be covering the rest of the session, the technical session. So that is the format of today's session. And these are the learning objectives. So having said that, this particular standard, I would like to share, will enable the insurers reflect risk on their balance sheet to wide-ranging insurance processes, for example, operations, data management, valuation, modeling, accounting, and reporting. And impact of IFRS 17 shall be felt even beyond the insurance sector. So now, thanks to IASB for deferment of effective date to Jan 1, 2023, which gives insurers much needed time for implementation. And this standard as replaces IFRS 4, which was an interim standard that resulted in widely divergent practices. My article on that note on IFRS 17 has been published last year in the Middle East Insurance Review as a focus article in one of the editions. So the earlier application of this article, the IFRS 17 is also permitted if IFRS 15 revenue from contracts with customers and IFRS 9 financial instruments have been applied. Now, before going deep, just to give you a quick idea in terms of the Middle Eastern scenario. So there is basically a renewed focus in the Middle East, as in the different parts of the world, to enhance risk management of insurance in the Middle East. And here, regional regulators in different countries, talking about UAE, Oman, and Bahrain, Saudi Arabia, different parts, different countries, they have taken a very serious view of this, more rightly so. And they have had a high level implementation timetable set in so that the, the regulated entities, the insurers, they are to speed in terms of their implementation, including dry runs, gap analysis, securing internal buy-ins, and follow through their plans within the tight timelines, which should lead to timely IFRS 17 compliance. And definitely, as we are all aware, there is a phased implementation strategy, which of course included the initial gap analysis. So this is broadly what's happening in the region. Time will not permit me in this session to go more deep at this stage on this, but definitely this standard establishes principles for recognition, measurement, presentation, and disclosure of insurance contracts within the scope of the standard. And its objective is to ensure that an entity provides relevant information that faithfully represents these contracts. So the information basically, it gives a basis for users of financial statements to assess the effect that insurance contracts have on the entity's financial position, financial performance, and cash flows. It also requires similar principles to be applied to reinsurance contracts, held, and investment contracts with discretionary participation features issued. But of course, there are certain key benefits, and I'll take you there as well in the subsequent slides. These benefits you can compare to the previous standard IFRS 4, which broadly include consistent accounting for all insurance contracts, updated information about obligation, risks, and performance of insurance contract. Importantly, increased transparency, quality, and comparability in financial information reported by insurance companies. To cut the long story short, the new standard calls for more transparency, security, communication, and trust. And this will bring about a restoration of confidence in insurance sector, M&A activity, usage of capital, cost of capital. For example, the use of current discount rate is one of the benefits of the new standard, which will enhance comparability between insurance companies, between insurance and other parts of the financial industry, for example, banks and asset management. There shall be increased consistency across companies in accounting for insurance contracts and a more theoretically valid measurement of revenue. So this was, I thought, very essential to give everyone a brief background to the technical presentation. So since the standard is vast and as rightly said previously by Guru C.A. Zavre, this is the most complicated standard and it is a very detailed standard. So timing, I'm repeating, is not sufficient, but I try to capture certain key elements which will give everyone a further flavor of the standard. So this standard, as we have seen, has taken 20 years to develop, and it has gone through certain stages in the development process. So without going deep into those stages, we are where we are. So I'll just give you a summarized timeline from 18th May 2017, where IASB issued IFRS 17 effective for annual periods. At that time, 1st of Jan 2021. Then there have been subsequent reviews at IASB level. And on 26th of June 2019, there were certain amendments. Then on 17th of March 2020, thankfully, the new effective date has been changed to 1st of Jan 2023. And then on 25th of June 2020, IASB has issued amendments to IFRS 17 contracts to help companies with implementation. So basically, this should be applied to annual reporting periods beginning on or after Jan 2023, with earlier application permitted, and the amendments should be applied at the same time. So this, together with an amendment to IFRS 4, so that eligible insurers, as I said earlier, can still apply IFRS 9 alongside them. So I mean, I'll not be detailing it further at this point, but this gives you a kind of flavor as to what the recent amendments are. And possibly there could be something else even before 1st of Jan 2023, which of course need to see. So the next, what exactly, we have been talking about IFRS 17. So what exactly is IFRS 17? It is basically a game-changing accounting standard for insurance, and it will result in vast accounting change insurance industry ever envisioned. I repeat, and its impact will be felt beyond authorized and regulated insurance sector. And what does it replace? IFRS 4. Why? Because that standard resulted in widely divergent practices. And what are the key benefits? Consistent accounting for all insurance contracts, updated information, as I said at the preview of this presentation, about obligation, risks, and performance of insurance contract. It enhances the transparency and adds comparability in financial information, which is reported by insurance companies. This is very, very important in today's times. So now we know what exactly is IFRS 17 and what are the key timelines up to which we are here. We have a summarized view of that. So now, what are the key differences between IFRS 17 and IFRS 4? I mean, you would appreciate that in IFRS 17, there is one accounting policy for all insurance contracts, which is different than IFRS 4, where there were different accounting policies per insurance contract. And as I said earlier, it brings about an element of better comparability than the previous standard, where there were issues related to comparability of insurance companies across different countries or whatever. And why this is so? This is so because there are similar accounting methods which are being applied in IFRS 17 versus IFRS 4. And estimates here are updated at the end, at each reporting period, whereas in IFRS 4, these estimates were not updated. So this is another important element. What the users of financial information like to see normally, they like to see the key drivers of profit, which was difficult in IFRS 4, whereas in this standard, it is more transparent. For example, investment versus underwriting. And discount rate, as I said, it's one of the benefits. So the discount rate in previous standard, whereas it was based on investment, here it is based on cash flows of the contract, which makes it game-changing and more relevant, more timely, more comparable. So we can go on and on, but this particular slide will enable everyone to appreciate the key differences and the benefits coming out of IFRS 17. Let me just show you a particular slide. The proof of the pudding is in eating. So there is how a typical, of course, the income statements and balance sheets will vary across insurance companies, but how a typical existing income statement will change. So here is the sample general typical existing income statement of an insurance company. Of course, there can be variations from company to company. So talking about, say, gross premiums. So here, this is now cash based, and this includes collection of deposits. And previously, this was inconsistent with other industries. So gross claims, benefits, and expenses will include the repayment of deposits, which was previously not included, which is another plus. Changes in insurance contract liabilities previously were quite confusing. I mean, it was open to interpretation from the preparers, from the reviewers angle, and from different stakeholders. But now that has been sorted, and which previously incorporated multiple factors exactly. So profit before tax, previously inconsistent measurement, which of course reduces comparability. I have said quite a lot about comparability. In a nutshell, the source of earnings was difficult to identify. So now we can. I mean, this is just a bird's eye view of a typical existing income statement as to what it was and how it shall look like. And now moving on from income statement, I'll reflect upon very briefly, give you a bird's eye view of a typical existing balance sheet. So this is basically a typical existing balance sheet of an insurer. And so basically, what are the benefits and what are the problems? So if you ask me, I mean, there were multiple line items, inconsistent terminologies. We'll come to the terminology bit in the coming few slides, because this standard introduces certain new terminologies which are exclusive to the insurance contracts. So many people may be not familiar. So we'll try to introduce that concept of familiarity with that. So inconsistent terminology, inconsistent measurement, difficulty to understand the changes. So this is a typical balance sheet. Now, if you ask me, what is the scope of the standard? So the standard, the insurance contract, as we know, establishes the principles through this particular standard for recognition, measurement, presentation, and disclosure within the scope. And objective, as I said earlier, and I do repeat, that this is to ensure that an entity provides relevant information that faithfully represents the contracts. The reason why I'm repeating certain important items is because the standard is new. So the items which need emphasis for understanding of further slides. So that's the reason for certain repetition of concepts, just for a bit more clarity and emphasis. So this information gives a basis for users of financial statement to assess the effect that insurance contracts will have on an entity's financial position, financial performance, and cash flow. So this is broadly the scope of the particular standard. So we have been talking about, as I said a minute before, what are the key terms this standard introduces. So there are a couple of key items I thought to share with you. Of course, we are aware that what an insurance contract is from an accounting perspective and from a legal perspective. So I'll not go deep into there, but definitely it introduces a term of the portfolio of insurance contracts, wherein the insurance contracts subject to similar risks are managed together. So that is the term that we need to be mindful of. A very recurring term which will come again and again is contractual service margin, or acronym for that is CSM. So it is basically what? It is a component of the carrying amount of the asset or liability for a group of insurance contracts representing the unearned profit the entity will recognize as it provides services under the insurance contracts in the group. And this is exact definition and application when we work on computing the CSMs. It's exactly this way, with of course a few changes here and there. So insurance risk, we are all aware about the financial risk. So the risk other than financial risk, which is transferred from holders of a contract to the issuer. And now coming to a very another important term like the CSM is the FCF, which is an acronym for fulfillment cash flows. What is FCF? It is basically an explicit, unbiased, and probability-based estimate. So what is a probability-based estimate? Which is based on the expected value, or you may put it of the present value of the future cash outflows, less the present value of the future cash inflows, and how they will arise as the entity will fulfill the insurance contracts. And in order for the entity to do so, what it must include? It must include a risk adjustment for non-financial risk. So now, what is the risk adjustment for non-financial risk? It is basically a compensation of an entity requires certainty about the amount and timing of future cash flows arising from non-financial risk. So the way you see it, there is a segregation between the financial risk and the non-financial risk, right? And for the non-financial risk, we are undertaking into account the risk adjustment for the same, right? So bearing the uncertainty about the amount and timing of future cash flows arising from the non-financial risk as the entity continues to fulfill its insurance contracts. So these are the important terms which we need to bear in mind once we move to the subsequent slides, as it will help you everyone to understand a bit better as we walk through the other ones. So then another important element this standard tries to bring in is separating the contracts, the various components from an insurance contract. Now the insurance contract may contain normally one or more components, and so that would be within the scope of another standard if there were the separate contracts. Now, for example, an insurance contract may include an investment component or a service component, or it can be both, either ways. So this is the beauty of this particular standard, is the separation of the contracts, the components. And these standards basically provides the criteria to determine the non-insurance component is distinct from the host insurance contract. So anyways, this is basically what about the separation from the components is. So how an entity can apply when it comes to IFRS 9 is, the entity can apply the IFRS 9 financial instruments to determine whether there is an embedded derivative to be separated. Why it has to be separated? Because it is in the context of this standard. It could be an investment component or a service component, or it could be both, right? As I said a bit earlier. So if assuming there is a situation like this, then in that case, there has to be a separation from a host contract in terms of IFRS 9 financial instruments to an investment component, if and only if that investment component is distinct. Now, in such a situation, the entity will apply IFRS 9 to account for the separated investment component. But there are certain steps which the entity shall perform, right? So once the entity is performing these steps, then they have to separate any promises to transfer distinct non-insurance goods or services as explained above. Such promises are accounted under IFRS 15, which is the revenue from contracts with the customers. So here we can clearly see the linkages between IFRS 9, IFRS 15, when it comes to separating the contracts components from the overall insurance contract. And as I repeat, which may include investment component or service component or even both. So that distinction and our understanding of that distinction becomes very important. In this particular standard, it brings about another concept called the level of aggregation, which is unique to this. Now, what exactly is the level of aggregation? This standard requires entities to identify the portfolios of insurance contracts. Here, the key word is the portfolio of insurance contract, which comprises the contracts that are subject to similar risks and are managed together, right? So contracts within a product line, for example, they may be expected to have similar risks, and they should be ideally in a similar portfolio if they are managed together, right? So that is the level of aggregation which IFRS 17 talks about. And of course, when you talk about a portfolio, it can be divided, into three parts. Like, for example, a group of contracts that are onerous at initial recognition. We all know onerous contracts we have come across in other IFRSs as well. And we'll come to the onerous contract as well. So a group of contracts that at initial recognition have no significant possibility of becoming onerous, or a group of remaining contracts in the portfolio, if any. So this is basically a very logical, a composition or a division that the standard looks into. But we need to be mindful here of one element, that an entity is not permitted to include contracts issued more than 1 year apart in the same group. So this is a very, very important, item that we should be looking at. And if the contracts within a portfolio would fall into different groups only because law or regulation specifically constrains the entity's practical ability to set a different price or level of benefits for policyholders with different characteristics, the entity may include those contracts in the same group. So as I said earlier, this may sound a bit more complicated because of the certain new terminologies and the complexities itself in the insurance contracts. So it's not a one-size-fits-all vanilla approach, because insurance contracts are also complicated and they are unique. For example, when you talk of life insurance contracts, when you talk of general insurance contracts, and then there are various varieties of general insurance contracts. There are various varieties of life insurance contracts. So this is basically a broad element brought into by the standard. Of course, certain things will vary depending on the nature of the company. So now coming to the basic element, which is about the recognition. So how an entity will recognize the group of insurance contract? Now there are certain conditions, right? So these conditions are like the beginning of the coverage period, the date when the first payment from a policyholder becomes due, and when the group becomes onerous. So these are the three items which will help the entity understand in terms of recognizing a group of insurance contracts. Of course, recognition is quite detailed, but these are the important elements which we need to capture in our mind when we talk of recognition. Measurement. Measurement is quite detailed, and there are certain measurement models as well, which Mr. James Ravi will be taking in the subsequent part. So talking about measurement, just to highlight certain elements about it. On initial recognition, an entity shall measure a group of contracts at the total of FCF. I have told you briefly about FCF, which is the fulfillment cash flows, and which shall comprise an estimation of the future cash flows, an adjustment to reflect the time value of money. Currently, the time value of money is not that well considered, but IFRS 17 considers an adjustment so that the time value of money is taken into consideration and the financial risks which are associated with the future cash flows. And on top of it, as I have discussed early in the previous slides, a risk adjustment for non-financial risk And we have also talked about the contractual service margin. So it is basically two elements. One is FCF, the fulfillment cash flows, and the other is the CSM. And apart from these two elements, when we talk of measurement, an important element to consider is all the cash flows which are within the boundary of each contract in the group. In such a situation, the entity may estimate the FCFs at a high level of aggregation and then allocate the resulting fulfillment cash flows to individual group of contracts. So at the first level, it is aggregated and then allocated at the individual group of contracts. And then we talk of the estimates of FCF, how they should be. They should be current, explicit, objective, unbiased, and they should reflect all the information available to the entity without undue cost and effort about the timing, amount, uncertainty of those FCFs. Now, we have seen here, right? I mean, we have talked about the time value of money and, so it is very transparent standard, if I may say so. So they would reflect the perspective of the entity, provided that the estimates of any relevant market variables are consistent with the observable market prices. So this is just a brief about measurement. And then discount rates is another, positive feature in the standard. And of course, again and again, we are talking about the risk adjustment for non-financial risk. So when we talk of discount rates, so the discount rates applied to the estimated cash flows shall reflect the time value of money, the discounted rates. And of course, they should be consistent, needless to add, with the observable market practices of those financial instruments whose cash flow characteristics are consistent with the insurance contracts. Now, if they are inconsistent, there is a caution, right? So we should also exclude any effect of factors that influences such observable market prices, but do not affect the future cash flows of the insurance contracts. So these are the three items that we need to be capturing when we are applying the discount rates. Not as straightforward as we apply the discount rates in other standard and any other standards. So the risk adjustment for financial risk covers basically the estimate of the present value of future cash flows when adjusted to reflect the compensation that the entity requires for bearing the uncertainty about the timing and amount of future cash flows that arise from non-financial risk. One thing we may have seen in these previous slides, the standard is very, very particular about the time value of money. All these elements will bring about more reliability, more accuracy, more transparency, more completeness, more comparability, which are highlights of this particular IFRS 17 standard. So let's give contractual service margin and subsequent measurement a thought. So basically, we have talked about CSM, FCF, so on and so forth. So what exactly is CSM? It is basically an unearned profit of the group of insurance contracts that the entity will recognize as it provides services in the future. Now, we are preparing the financials on a going concern basis, not on a liquidation basis, right? So the entity is supposed to recognize as it continues to provide the services in the future. So that is where the role of CSM comes in. And this is measured on initial recognition of a group of insurance contracts at an amount that, unless the group of insurance contracts is onerous. Remember, I have talked about onerous as an exception in one of the previous slides. If it results in no income or expenses which arise from the initial recognition of an amount for the fulfillment cash flow, or the derecognition at that date of any asset or liability recognized for acquisition cash flow, and any cash flows arising from contracts in the group at that date. And of course, there is a subsequent measurement as well, wherein the carrying amount of a group of insurance contracts at the end of each reporting period. So what it shall be? it shall be the sum of two elements. A, the liability for remaining coverage comprising FCF related to future services and CSM of the group at that date. So we are talking about liability for the remaining coverage or the outstanding coverage, right? And the liability for incurred claims. So these are the two elements which need to be added. And what does liability for incurred claims include? It comprises basically the FCF related to past service allocated to the group at that date. We were talking here about the onerous contracts. So onerous contract is the one, it is onerous at initial recognition if the total amount of fulfillment cash flow or any previously recognized acquisition cash flow and any cash flows arising from the contract at that date is a net outflow. So the key word here is, if this condition results in a net outflow, then the insurance contract is becoming onerous. And now we know, which we have discussed in the previous slides, that if the contract is onerous, then where there are certain exceptions which are associated with it. So an entity shall recognize a loss in profit or loss for the net outflow resulting in the carrying amount of the liability for the group being equal to FCF and the CSM of the group being 0 in such situations. Now another element here I would like to emphasize in the case of subsequent measurement. If a group of insurance contracts becomes onerous or more onerous, that excess shall be recognized in profit or loss. As simple as that. But again, this condition is for the subsequent measurement. And additionally, the CSM cannot increase and no revenue can be recognized until the onerous amount previously recognized has been reversed in profit or loss as part of a service expense. So this briefly talks about the recognition and various items which we need to be mindful. Now we move on in interest of time to the presentation element. So basically, an entity shall present separately in the statement of financial position the carrying amount of 4 groups. So what are those 4 groups? The insurance contracts issued that are assets, that are liabilities, reinsurance contracts which are held that are assets, and reinsurance contracts held that are liabilities. So there is a segregation between the insurance contracts issued as asset, liability, and reinsurance contracts held as assets and that are liabilities. So these are the 4 elements which we need to take into account while presenting in the statement of financial position, and they need to be presented separately, the carrying amount of these 4 groups. Now, moving on, recognition and presentation in the statement of financial performance. So an entity basically shall disaggregate. We were talking about aggregation. Now we talk about disaggregation. So the entity shall disaggregate the amounts recognized in the statements of financial performance into 2 parts. What are those 2 parts? An insurance service result, which comprises insurance revenue and service expenses, and insurance finance income or expenses. Income or expenses from the reinsurance contracts held, as I said in the previous slide, they shall be presented separately from the expenses or income from the insurance contracts issued. The key word here which we need to take into account is separation between insurance and reinsurance. We cannot club it. And then when these are the certain conditions which need to be met. I talked about the insurance service result. So what exactly is the insurance service result? All these are new terminologies which this standard brings in. So just as a quick one, an entity shall present in profit or loss revenue arising from the group of insurance contracts issued and insurance service expenses arising from a group of insurance contracts it issues, comprising incurred claims and other incurred insurance service expenses. So the revenue and insurance service expenses shall exclude. The key word is, what are the items that are excluded? Any investment component should be excluded, and an entity shall not present premiums in the profit or loss if that information is inconsistent with the revenue presented. So what we need to take into account is one word, which is consistency. If there is some inconsistency, we need to review before calculating the insurance service result. Moving on, the insurance finance income, the insurance finance income or the expenses. Now, again, this is very detailed. I'll just quickly run you through on this in interest of time. So, as I said earlier, the standard is too vast. So it's a bit challenging to cover in this much time. So insurance finance income or expenses comprises the change in the carrying amount of the group of insurance contracts which arise from, first of all, the effect of time value of money and changes in the time value of money, and the effect of changes in assumptions. Now, we make certain assumptions, right, when it relates to financial risk, and there could be changes over a period of time in the assumptions. So that needs to be taken into account. And also we need to exclude any changes or groups of insurance contracts with direct participating insurance contracts that would instead adjust the contractual service margin. So, and also on top of it, the entity needs to have a proper accounting policy choice, as to what items are captured in the insurance finance income or expenses for the period of profit or loss. Or the reviewers or the stakeholders who would like to see the financials. Now there is a general model. Anyways, Mr. James Ravi will be covering, and the VFA approach also is covering, so I'll not be going deep there. Another element I would like to talk about is very critical. It is about the implementation challenges which this standard brings in. And very rightly so, since this is a very complicated standard, a tough standard, it's bringing about a paradigm or a disruptive change, which we have been talking about time and again during today's event. And the industry also is very particular, the regulators are particular, IASB is particular, and they better need be, everyone should be. So what are the key implementation challenges? So basically, there are a lot of implementation challenges. The first element, is understanding of the standard. This standard requires enormous implementation effort on part of the insurers across the organization, be it technology, the business processes, controls, people, reporting, investor relations, whatsoever. And of course, this shall also involve comprehension of financial and operational impacts on transition and for new business, implementing efficient data collection and storage solutions, because IT is a key component here. We need to be very, very mindful of this. Streamlining the production processes and IT systems, new performance measurement and business metric focus, and on top of it, the boards need to be setting aside a separate budget because implementation costs are likely to be enormous. But trust me, the standard will bring about benefits in terms of improved transparency, consistency, and comparability, which will, over a period of time, offset the costs brought in, and agreed to by the boards for the insurance companies. And this transition has wide-ranging implications for all key areas from the board's perspective. If I may give a line on the board's perspective, for example, the financial strength, the strategy, business transformation, actuarial models, because the actuaries will be heavily involved when it comes to implementation of this. IT architecture, data systems, people and processes. So these are the elements from a board's perspective, which will be for the management to bring to board's attention that how these areas will be affected and what are the potential benefits which are being accrued. So also this particular standard, it is bringing about a very, very comprehensive project-based approach, which many of the insurers led, overseen by the regulators, and as a good practice, have a comprehensive project plan. And based on my understanding, the insurers worldwide and importantly in the Middle East, they are at different stages of implementation, which is very good, so that they can comply with the timelines and strict requirements laid down by IASB. Impact is not only on the profits, equity, insurance obligations, and financial reporting, I repeat, but also on the actuarial models and IT architecture. This is because of the changes suggested in the standard around consistent accounting treatment of insurance contracts, measurement of contracts, and wide-ranging disclosure requirements. And disclosure, Mr. James will be sharing in the next subsequent slides in the next few minutes. So there is broadly impact on data and systems, impact on processes, people, and of course, impact on models. We see a significant impact on IT systems and architecture because the valuation models are getting impacted. There will be changes in reporting. There will be changes in reconciliation. There will be changes in how the data flows, within an organization. For example, the valuation model, application system, data governance, general ledger, management reporting, reconciliations. We can go on and on, but this is just to give you a broad bird's eye view. And when we talk about such a game-changing standard, needless to add, there is going to be a change, massive change in the processes of how an insurance company operates, if I may put it that way. And not just in current accounting, reconciliation, and closing processes, but due to increased complexity across the business, even on the operations, how the business is seen, how the business runs. So, they will have to, the insurers will have to refocus as to how they can fast close the initiatives and closing the processes, the accounting closes, for the optimization and efficiency to happen, efficiencies and to be realized, and effectiveness to be there. So these process changes, they need to go in parallel. You can't operate in silos, these different phases. They need to be properly aligned to financial statement generation and reporting processes. And of course, the main element is the man behind the machine, which is the people. And the people need to be very mindful, the teams involved, and right from the board, the chair, to the people down under, the kind of impact it is going, not only having technically, but also on their perception and their way of working. And there will be, of course, it will enhance the new normal, what we are doing, the automation, and of course, a fewer manual processes will be required for the new working methods. So there will be training requirements for IFRS 17 on an ongoing basis, firstly before it go live, and subsequently post the go live. And of course, there will be requirements possibly coming up in the future for IFRS 17 audits, IFRS 17 compliances, and training is a must before and after as well at different levels. And importantly, there will be an impact on models, which is a big challenge. The valuation methodologies get changed. Existing models will have to be readjusted, refurbished to adjust. And the valuation models, especially, they will require updating, and new reporting models will need to be defined. For example, the models that will be impacted will include evaluation, accounting, reporting, so on. So, I mean, that brings me to the close. I've taken a lot of your time, and the Q&A, as I said, if time permitting, we'll do today. Otherwise, we'll do it subsequently. We'll respond to the queries, and we welcome the queries. And without further ado, I would like to thank the chair and the office bearers of ICAI Oman for giving me this opportunity to present in front of such an august audience and to be part of Teachers' Day celebrations. I wish ICAI Oman all success for this event and for future. So thank you everyone once again, and over to Mr. James Ravi for the second part of the presentation. Thank you everyone.
Thank you.
Thank you, Dr. Alok Kumar Agarwalji. Any questions members have, they want to ask, or they can type it in the Q&A window.
Let's go ahead with the next. Maybe we can take in the question later part.
Thank you, Dr. Alok Kumar Garwalji, for the very apt and organized presentation for the most disruptive accounting standard. I'm sure though the costs are high for IFRS 17 adoption, the implementation will bring in transparency, consistency, and comparability. And it's going to be a challenge for all the professionals who are working within the insurance companies, and obviously the consultants who will be helping the insurance companies adopt the or implement the IFRS 17. So thank you for guiding all the members. Now I request CA Gaurav Kapoor to introduce our next speaker, CA James Ravi. Over to you, Gaurav.
Thank you, CA Unmesh, and good morning, everyone. I know CA James has been a long time, known to people in Oman. But for any fresh who are there and listening, he's highly experienced and have a rich experience of more than 25 years in finance and accounting functions in oil and gas, telecom, manufacturing, trading, service, and any other industry you name it, especially the insurance, where he's going to share some insights in a short while from now. CA James Ravi is also a fellow member of Institute of Chartered Accountants of India and also a member of American Institute of Certified Public Accountants. Many of us would have read his articles in the newspapers on IFRS and other important technical matters. And of course, not only newspapers, but many other professional journals as well. A prolific speaker at training sessions to accounting and finance professionals is just a small introduction for CA James Ravi. I hand over to you, CA James. The screen is yours.
Thank you. Good afternoon, everyone. In fact, it's still good morning. Dr. Alok has covered extensively on the standard for making my job a little easier. I will be covering the other four aspects of IFRS 17, which is measurement and remeasurement, presentation and disclosure. As you know, in Oman, CMA, the regulator for insurance sector, the Capital Market Authority, have come out with the proper guidance in the year 2018 onwards. They've been continuously coming out the guidance for the phases in implementation of IFRS 17 for the insurance sector. And they divided the whole process into 3 phases, and already 2 phases are over, and all the insurance companies are taking up the 3rd phase, and effectively it should come into by 31st or 1/1/2023. Because of COVID, it got postponed by 1 more year. So it will be effective 1/1/2023. Having said that, it's my great privilege that I could talk on this to this august audience. I'd like to especially thank the chairman of ICA Muscat chapter, Mr. Ravi Vira, and the other committee members, and especially thanks to Dr. Alok, who has been my colleague and my predecessor who did this presentation, and for his extensive coverage, and especially Dr. Zavre, whom I know for many years, and though I didn't have the privilege of being a student to him, and I enjoyed his presence and his teaching very much as a member. And even today, he covered extensively on IFRS 17, the history and how it is come up today. And let me take you into the standard quickly. As we speak today, we all would have got the news, what's happening in the East Coast of United States, how Hurricane Ida is creating a devastating effect on the East Coast, in the New York City and the Connecticut and the New Jersey. Entire East Coast is very badly affected by Hurricane Ida. Imagine if you are an insurance company which issued some insurance policies to cover the life and properties risk of such a humongous damage. And IFRS 17 expects you to have a crystal ball type of and help and predict such an event and quantify the total damage that would have occurred by way of direct damage and the collateral damages, and creating a liability and bringing it onto your books as of 31st December 2020 when you prepared your financial statements. Imagine the amount of expectation that IFRS 17 has from insurance sector. That is what we are talking, and that is why the earlier speakers mentioned rightly that how complex the standard is. This is one of the most complex standards of the entire body of knowledge of IFRS we have. And earlier, the standard, which is IFRS 4, which came in sometime in 2003, was not a standard at all. It was almost like a free pass given to all the insurance companies to do whatever they want to do in their presentation of financial statements. What I mean is there was no proper guidance given, because at that time, globally, the insurance sector was having a wide, varied practice of measuring the insurance liabilities, which we call as IBR and the IBNR, that is incurred but not recognized, and incurred but recognized. For that type of terms were used, and the practice was quite variant. So it took 20 years for them to come out with IFRS 17. Now we are talking about applying one model covering the entire globe and covering the entire ambit of the insurance segments we are talking about, like property insurance, marine insurance, commercial insurance, and life insurance. So that is why this complex has this standard has to be so complex, and it provides 3 different models, and we will see how these models are getting in our way. And let me move this. Yeah. For the 3 models given in IFRS 17 are known as, one is the general measurement model, which is known as the building block approach as well. And number 2 is a premium allocation approach, which is called the simplified approach, but in practice, people are finding even that is complex. And the variable fee approach, which will be used for insurance policies issued together with investment facility, where the insurer can charge a management fee for the insurance, for the investments. For that, they are going to apply the variable fee approach. For the most important model among the 3 is the general measurement model, which is the building block approach. Now, the idea is, as users of the financial statement, they should understand how the company has measured its revenue for the current year and how it measured the premium that is allocated for the future liability and how it measured the exact future insurance liability they are covered by the contracts issued, and bring them all into the balance sheet and the financial statements of P&L and others. So that is a real challenge. So you see, what really happens is, in IFRS 4, we have just 2 terms used, IBNR, and it's not much very well defined, and you had a freedom to play with that. But in IFRS 17, I talked earlier about IFRS 4. IFRS 17, we are introduced with 4 different terms, which Dr. Alok covered. The CSM, which is a contractual service margin, is nothing but the unearned profit as of date. And the LIC, the liability for incurred claims, which is known, though the quantification may be in pipeline, as a loss assessors would have been assessing the loss that's happened. But some semblance of probability that happened and the amount could be arrived at. But the big area is a liability for the remaining coverage. If it is a policy given for a multiple year, at the end of your first financial year, how much is the liability that you're going to measure and present in your financial statement? Certainly, it involves a huge work from actuaries, and actuaries will need to help us in that, and they would give these figures. And as finance professionals, we need to know what it means and how to present them in accordance with IFRS 17 in our financial statement. So as IFRS 9, if you remember, brought in of a need that finance professionals have to coordinate with the risk professionals to measure the risk and predict the expected credit loss under IFRS 9 and bring them on balance sheet. In IFRS 17, the standard expects the finance professional to be total coordination with the actuaries and bring these figures, these parameters or these elements into the financial statement. So it's a heavy actuarial work-based standard, and we cannot apply and implement the standard without actuaries. The role of actuaries have increased multifold compared to IFRS 4, we can say. So all these terms have been explained by Mr. Alok, so I don't want to go further into that. But what really happens is, as I said, these 5 more items are also known as the building blocks that needs to be brought into the books of the financial statement. So that's why the first model, which is called the general measurement model, is also known as building blocks. What are the building blocks? As Dr. Alok mentioned, this contracts, the insurance contracts which are issued will have to be grouped under 2 major categories, that is the segregation and desegregation. One of the main categories is going to be based on the profit. For on the day one, when you issue as a company an insurance contract, you're supposed to group a bunch of contracts are issued. We call that as a portfolio of contracts. To group them, those contracts which are going to make profit and those contracts which are going to make loss. You may ask a question, why do you issue a contract which you know very well is going to incur a loss? Well, there could be so many reasons for that. We don't want to go into that. So as an insurance company preparer of financial statement, you need to group them into these 2 portfolios or 2 groups. So these groups are basically based on the fulfillment of future cash flow. That is a cash flow driven presentation. The whole IFRS 17 is going to be cash flow driven presentation. So what we are supposed to do when we create let us say the first group, which is a group of profitable contracts, we are supposed to know what is the present value of the future cash inflows, which will be nothing but the premium collected or any other investment income, anything related to that. But I'm not talking about the insurance contract where you are having a life insurance covered with investment. It could be a pure commercial insurance. It could be a property insurance. It could be a car insurance. It could be a project insurance where you have a multiple periods covered and the premium going to be collected in over the period of the coverage. So that is the present value of future cash inflow. And that is broken down. Again, this is going to be measured and given to you by actuaries because you know the value of that, but the discount rate to be applied is a big question in IFRS 17. That also involves the need for the work of actuaries. So they will have to compute this figure and give. And these future inflows will be broken down into 3 building blocks. One is the present value of the cash outflows. This is nothing but the expected future claims that would happen, the loss that would occur in the claims admissible under the policy. So that needs to be measured. Again, it's a present value, it needs to be discounted. Then we talk about the non-financial risk. I don't know why the standard doesn't call this as an insurance risk directly, but it is nothing but the insurance risk because all the risk in this scenario is broadly divided under financial risk and non-financial risk, which is basically insurance risk. And that is going to be measured. The left out portion of the cash inflow is going to be the contractual service margin. For example, the present value of the future cash inflow is going to be 100 and the present value of the outflow is expected to be 70 and the non-financial risk adjustment is going to be 10. That means this contract would give a profit and that profit is going to be 20. That is called the contractual service margin. But you can't take immediately to the P&L because this needs to be covering over a period of 4 or 5 years. So we need to allocate it on the new model. It's not a straight line approach, a simple approach. It's a complex thing. Let's see how it is done with some numerical examples. So that is going to be a group of profitable contracts. On the other side, if you talk about the non-profitable contract, which is a loss-making contract, which is also known as the onerous contract, In that scenario, the expected future outflow and the non-financial risk adjustment is going to be exceeding the present value of the future inflow. As a result, you have a loss component. Okay, and as you know very well, when it is a loss, it needs to be immediately recognized. So that's how the standard defines. So let's see and understand this with a numerical example that will make the points clear. Well, let's see an insurance company. I just given in red color the important figure data, so it'll be easy for you instead of reading the whole slide. So an insurance company which is going to give a 4-year insurance policy covering starting from 1/1/2021, and the total premium is 2,080, which is for all the 4 years together. And the acquisition cost, there's nothing but the brokerage to be paid, is going to be 64 on day one. For day one, it will be paid. Let's assume that full premium is collected upfront, which is covering for a period of 4 years. And once this is done, we have to take it to the actuaries, and companies' actuaries, whether they are in-house actuaries or external specialists, give you the two data which is required. That is the fulfillment cash flows, which is the future claims and expenses incurred will be 360 per annum. That means for 4 years, it's going to be 1,440. And then they will also measure and give you the figures, which is a non-risk financial risk adjustment, which is going to be $84. From this, we understand the total inflow is 2080. When you minus the brokerage that's paid, it will be 2016, from which you are going to pay an future expected claim of 1,440. That is at the rate of 360 per year, multiplied by 4 years, and that will be deducted. And the 84 NFRA, non-financial risk adjustment, will be deducted. Or you'll be net having a 492 as your profit, which will be called the contractual service margin. Okay. If people have missed it, I'll just going to put it in the next slide. You will see that and understand that very clearly. Now the company has a policy of the non-financial risk adjustment and the contractual service margin to be recognized in the P&L over the covering period on a straight line basis. Now this is an accounting choice given by the standard. The insurance companies have evaluated and see how the cash flow occurs. Accordingly, they should choose the right option, and straight line basis is an easy one, which we have taken for this example. So that's the data. So when we recapitulate the data and put it on a single slide, that is going to be called the liability for the remaining coverage. That is called the LRC, which is one of the very important elements in this whole IFRS 17. So the LRC is computed or presented in this way. The present value of the future inflows, that's going to be 2080, and the outflows in the beginning is 64, the brokerage given, and the expected future outflow, which is going to be 1440, which is totally 1504, and which will give you a net inflow of, inflow being excess of outflow, a net inflow of 576, out of which you will have to keep separate allocation for the non-financial risk adjustment, which is 84, and which will leave you with a contractual service margin. That is a profit made in this contract, in this portfolio of contracts, if everything goes according to plan. If not, then these figures will change. So as we progress into the actual data in the coming years, these figures will keep changing. But for our understanding, we'll take that this figure doesn't change, and we just for simplicity purpose, keep it simple for easy understanding. Once we have done it, what will be the journal entry that we'll be making on day one when the policy is issued? So that's going to be debit bank account for the money coming in, and credit the acquisition cost, the brokerage to be payable. If it is paid, again, another entry to be paid, made, and the future claims, which is the LRC and the NFRA for 84 and credit CSM 490. Now, these three building blocks, that is your 64, 1440, and your 84, how they are going to be allocated in the coming years and hitting the P&L and the balance sheet is what IFRS 17, the general measurement model, covers. That's why this is called the building block approach. In fact, the slide is will be given, shared with the chapter, and you are free to share it with the participants if they are interested in knowing that. So once this is done, let us see how the LRC statement is prepared, and every year that is going to be the main exercise. Now, what is LRC? The liability for the remaining coverage. We will have to prepare this schedule according to IFRS 17 and keep it. It looks complex, but it's simple, straightforward. Now, you see column-wise, there are 3 columns, which are the present value of the cash flows and the non-financial risk adjustment and the contractual service margin. And opening balance, since this is the first year, there is no opening balance because this is policies are issued only this year. And on the day of issuing the policy, we assess the net cash outflow, net cash flow of 576, which is the total of NFRA and the CSR. Though it is computed at the end, in the presentation, this comes on the top. By the way, this is not in the balance sheet or P&L. This will be in the notes. For these figures will be brought to the face of the financial statement, P&L and balance sheet. And then the net cash inflow, the second line, 2080 minus 64, that is accounted. As a result, that gives you a net cash flow of 1440. And that is consisting of your 84 NFRA and the CSM. And the net will be, the total of them will be 2016. The same figure is given in a different way. That's it. Now the question arises, how much of this has to be taken to the P&L for the first year, which is 31st December 2021. So out of the total cash flow of 1440, which is consisting of 360 into 4, for the first 360, the claims are already made and they are paid, that's assumption, and so that will be taken to P&L. Then out of the 84 NFRA, the company adopted a straight line method, therefore they take 21 to the balance sheet, and out of the CSM, the unrealized profit of 492, they will book a profit of 123, 1/4 of that straight line method, the P&L. So that will leave at the end of the year the building blocks of the insurance liabilities as 1080 towards the future expected cash outflow for the claims to be made in future, and NFRA balance 63 and the CSM balance 369, a total of 1512. Now, once we understand this, now we can go and prepare the P&L and see how these figures are presented in the P&L. When we look at the P&L, we understand the first figure is 520. From where in the world we got that figure? That's nothing but the combination of the 4 building blocks that we initially made in the previous slide. For the expected claim, which is 360, and the actual claim is also 360, therefore that's going to be your revenue, 360, because we already collected the cash and expected the cash as per the actual evaluation, and the NFRA 21 and the CSM 123, and the covering of acquisition cost, the 84 divided by, the 64 divided by 4, which is 16. Therefore, the total of all of them is going to be 520. Look at this. This is going to be completely a reverse process of revenue. It's almost like a re-engineering of the revenue figure. That is why IFRS 17 is seemingly complicated, because it gives a new understanding of assessing the IFRS, the revenue, which is a top line in the P&L. This is a very important calculation. This is where IFRS 17 differs, I would say. And what are the expenses that we are going to present this year? Of course, there is a claim of 360 and it is paid, therefore that we put, whether it's paid or not, it has to be booked. And the acquisition cost of 16, that is going to be there, which is the total is 376. That will give you an insurance service result of 144. So that is going to be the profit booked this year. Now, if having done this, what will be the balance for the coming year? That should be presented in the balance sheet. Since I'm taking you through the slides fast, it may look slightly complicated. When you have time, if you go through the previous slides and then try to match, it will be much easy. It's all new to us because the methodology adopted is new and the terms are new. Otherwise, it's simple and understandable. So in the balance sheet, what we are going to see is total assets of 1656. How is it coming to be? Premium collected 2080, acquisition cost 64, and the claim settled 364. We are having a balance of 1656. Of course, other assets will be there, that is left out for simplicity purpose. And the liabilities will be 1656, consisting of your liabilities for the remaining cover LRC 1512, which is there in the previous slide, and the current year profit, which is hitting the retained earnings 144. So the total is 1656. So that's the simplest example I could bring in. We can make it very complex, and we can have 2 days of training on this. That's what it takes. When we conducted a training in the year 2020, January or March, I think it took 2 days for us to cover extensively. So still we are available. If anybody is interested in having such a training, you can approach us after this event is over. So that's how the whole thing goes about. So this is a first model, the GMM, General Measurement Model. The other two models are premium allocation approach, which is a straightforward, simple approach. And this is to be used only for short-term contracts. When they're calling short-term, that means less than 12 months. And though they thought that it will be a simple approach, in practice, we are seeing, and we are having interaction with insurance companies, telling them that, hearing them from them, that it is really complex. This is also not that easy to apply. Well, for that is premium allocation approach. And the third one is a variable fee approach, as already mentioned by the previous speakers. This is a direct participation feature where there is an investment linked with the insurance, and when there is a management fee collected, how it is to be accounted. That's how it is. So these two approaches are slightly simpler than GMM. And with that, we can go ahead with the next one. So the disclosures are basically going to be huge as the users to assess the effect of the contracts. That's the idea. So you need to give a huge disclosure in your financial statements. Basically, it is going to be grouped under 3 categories: the amount recognized in the financial statement, how they are coming to be that amount, and the significant judgments, which are a huge area because we need to cover a lot of actuarial parameters into this, and the nature and extent of risk. So these are the broad disclosures, which is a long list. Transition, yes, on 1/1/2023, 3 options are given. As we all experts in transition in the past couple of years, we've done IFRS 9, IFRS 15, IFRS 16. So it gives again 3 approaches: full retrospective approach, modified retrospective, and fair value approach. We can think about the best one, which is suitable to you as an insurer. But here, one point we have to keep in mind is, as you know, insurance companies are exempted from applying IFRS 9, though others applied effective 1/1/18. Until they apply IFRS 17, they are given exemption to postpone the implementation of IFRS 9. Therefore, when they go for IFRS 9 as a 1/1/2023, they will have to parallelly implement, if they're not done it earlier, IFRS 9 as well. And here it becomes critical as they create big synergy between them. What it happens is, look at the next slide. See, IFRS 9 is going to create the balance sheet. Financial assets are measured there, amortized cost, fair value through P&L, fair value through OCI. Therefore, that's covering the asset side of the balance sheet. And IFRS 17 is going to hit the liability side of the balance sheet, where you're going to hit with the actuarial value. So there also, how IFRS 9 gives 3 approaches or 3 categories of financial assets. Here we can have 2 approaches, one through actuarial value through P&L and actuarial value through OCI. Here it becomes a challenging task for the finance manager to choose the right accounting policy of both assets and liabilities, so that they will not land up in a mess by creating a mismatch between the asset and liability and having a huge loss booked in 1 year and a huge gain booked in another year, creating a volatility in the P&L. So that's the main thing as a finance professional they need to look at and avoid. Well, with that, I've completed my presentation. Once again, thanks to the chapter and Dr. Zavre and Dr. Alok, and thank you. Over to the chairman.
Thank you, CA James. Any members have any questions? So can take it up, or they can type it in the chat box.
Members can raise their hand also. They can pull them on the screen to allow to speak.
Yeah, we can. Anybody has raised the hand? No.
I think the session was so excited that everybody understood it very well, and they want the presentation. The people have asked that presentation has to be shared, so that's there.
And we have also clarified that the recording will be available in the YouTube. So the link will be shared to the members in due course.
Yes. Yes, obviously we can continue.
Okay, no worries. Thank you, CA James Ravi, for simplifying the complex technologies, terminologies in the IFRS 17 and the approaches for the benefit of the members. Though we could not get into the nitty-gritties and the complexities due to the limitation of the time, we thank you for your guidance. And we hope that the insurance companies are already geared up for the transition to start working on the comparable numbers from the next year onwards, and doing those difficult choices to avoid the volatility in the income. So let's see how it comes. We are all waiting how it will be implemented by the insurance companies in the region. So thank you once again for the guidance. May I now request all the panelists to pose for the photograph together. If we can unpin. Yeah, so everybody can be in the gallery view.
Please switch on the video. Please switch on everybody's video. Okay.
Done? Yeah, thank you. So now may I request Mubinji to felicitate Lokji.
Thank you, Unmeshji.
Just a second,
Dr.
I'll
Alok,
share my screen.
Thank you very much for being with us and for your talk. And we like, as a token of our appreciation, we present this certificate to you. Please accept our certificate and oblige. And thank you again very much for being with us and sparing time for our program.
Thank you so very much, sir. Indeed, it is my honor to be here with all of you, and thank you so very much for the felicitation. Wishing all the very best for future for ICI Oman. Thank you.
Thank you very much, sir.
Thank you, Dr. Alok, and thank you, CA Mubinji. Now I request our past MC member Shahnawaz Khan to felicitate CA James Raviji.
Thank you very much, Unmesh Bhai. I guess James sir has always been very, very kind, and speaking on IFRS 17 has been very difficult because I've been doing it over the years as well. Thank you very much, sir. And your sessions are always, people accepted with great applause. And I remember IFRS 9 session as a package I organized it. So that was also very well taken. Thank you very much for your effort. And so please accept it as a token of and it's a very well done program for Muscat chapter. And, as much as I can remember, a couple of words, I suppose Mubin Bhai said something about the humility, and Zawaris have said something about the perfection. And so these are my takeaways as well. Thank you very much, sir, and always look forward to hear more and more.
Saji and the chapter, the chairman and the management committee members for this opportunity. I'm always available for any help and any queries. You can write to us, and we do involve ourselves in implementation, and we can help you in that. Thank you.
Thank you, CA Shahnawaz. Thank you, CA James Raviji. Now, may I request CA Sajeev Ji to give the vote of thanks, please.
Thank you, Unmesh Ji. Thank you. A very good morning to you all. On the occasion of the Teachers' Day, I wish you everyone happy Teachers' Day. On behalf of Muscat chapter and members and managing committee, I congratulate Dr. Sahran Al-Salti for being elected as Dean of CBFS, our local sponsor, and thanking him for being here today as our chief guest. With great pleasure, I thank the CA Sabra sir for his presence and keynote address and a brief session on IFRS. I thank Mubinji for his sharing wonderful thoughts, words, and his time to make this as a truly as a Teachers' Day from his memories. I thank Davis sir for his presence, Davis sir and Shanawaz sir, Shanawaz Bhai, Shanawaz Khan for his presence, joined as a member of a panelist. I take this opportunity to sincerely thank Dr. Alok Kumar and CA James Ravi. In Oman, IFRS means the first name. One of the first names which comes to our mind is James sir. So, so there is no much of introduction or formalities required. Thank you, sir, for an excellent presentation on a complex topic in such a beautiful and simple way. And also a special thanks to Digan, CA Diganji, for his wonderful effort for the job portal, which we all have decided to come up with something for the members, benefit of the members. So that he has spent a lot of time, and with the support of all the members, it has come up very well. And with this, I thank CBFS for their continued support. Also the members of Muscat chapter and the participants for their excellent participation for the event and the questions and answers. Thank you so much. Wish you all the very best. Thank you.
Thank you. Thank you, sir.
Thank you, Sajeev ji. And on a lighter note, we are all students forever, and it is because of the special teachers around us who make the learning a great journey for us. So that's I just thought I will share with you on the great occasion of Teachers' Day. And then on a lighter note, I've been always prompted for some shairi. So just on एक अर्ज करूंगा. काश प्यार का इंश्योरेंस हो जाता, काश प्यार का इंश्योरेंस हो जाता, प्यार करने से पहले प्रीमियम भरवाया जाता.
क्या बात है.
प्यार में वफा मिले तो ठीक, वरना बेवफाओं पे जो खर्चा होता उसे क्लेम में मिल जाता.
बहुत अच्छा.
Thanks to Google, but then I think on a lighter note, I thought of sharing it with you all of you. So thank you, everybody. Anybody wants to share any views, or any participants wants to share or address the gathering with their experience or any other insights?
Raise your hands.
Please raise your hand so we can add you in the you can see on your videos and audios.
शाहनवाज भाई आए हैं, उनसे भी कुछ सुन लो, वो तो तैयार होंगे.
हाँ शाहज भाई, anything you want to share?
उमेश भाई, बस मैं थोड़ा सा try to juggle with here and there with children keeping quiet. No, it was really a great session, and it's always been a privilege, I suppose, to hear sir in any way. Mubin bhai is there in any way, so in front of him, I guess my all shairi is not that good, but I'll see if I can present maybe a little couple of lines. So how is everybody? How's Corona? I can sense the airport is open now. So hopefully,
the movement is now freed up, so hopefully the flight should start.
Okay, so I think the poem which I have written it a little while ago. This is about reflection, as Mubin bhai has said something about, and Jawahir has said something about the perfection and humility. So this is in Hindi, and the poem title called Nazar Na Lag Jaye.
No.
अक्सर लोग ये है कहते, ये मत करो, वो मत करो, इससे बचो, उससे बचो, इससे बचो, उससे बचो, बुरा काम करो तो छुपाओ ना छुपाओ, अच्छा काम करो तो जरूर छुपाओ, कहीं नजर न लग जाए. समाज का भला करो तो छुपा के करो, समाज का बुरा करो तो खुलेआम करो, कहीं नजर न लग जाए. औरतों को बदनाम करो तो खुलेआम करो, औरत कोई अच्छा काम करे तो बस अपना ही अपना नाम करो, कहीं नजर न लग जाए. बुरी आदत हो तो सरेआम करो, अच्छी आदत हो तो बयान न करो, कहीं नजर न लग जाए. जिनकी नजर, अब ये मैसेज आता है कि आई गेस एज अ पर्सन हाउ वी कैन गिव अ मैसेज टू देम, या अगर हम कैसे रिएक्ट करें, कि जिनकी नजर मुझ पर है, बाकी ना कोई काम घर और दफ्तर में है, देता हूं मैं उन सबको एक सलाह, देता हूं मैं उन सबको एक सलाह, अपनी नजर को इधर उधर ना घुमा, अपनी नजर को इधर उधर ना घुमा, बस अपने आप को देख, और अपना रास्ता बना। जब नजर भटके तो ये याद रख, आदमी अपनी मेहनत से आगे बढ़ता है। मन में आग जलाने के लिए तन को रोज फूकना पड़ता है। हर कामयाबी के पीछे लाखों संघर्ष होते हैं, दिन और रात दोनों एक करने होते हैं। कभी सबसे तो कभी खुद से लड़ना होता है, बार बार हर पल में जीना और मरना होता है। तब कहीं जाकर मिलती है कामयाबी, तेरी एक नजर इस पर कैसे लग जाएगी, मेहनत और मेरी माँ की नजर तुझ पर भारी पड़ जाएगी। मेहनत और मेरी माँ की नजर तुझ पर भारी पड़ जाएगी। लेकिन दोस्तों कुछ नसीहतें जरूरी हैं कि हमें क्या करना चाहिए, कि दोस्तों कुछ नसीहतें जरूरी हैं। तकव्वुर से बचो, मीन्स घमंड और एरोगेंस से। दोस्तों पर तकव्वुर से बचो, तौबा और तिलावत करते रहो, मीन्स आस्क फॉर फॉरगिवनेस एंड रीड रिलीजियस बुक्स एंड समथिंग गुड। सो दोस्तों पर तकव्वुर से बचो, तौबा और तिलावत करते रहो। देखना जिनकी तुम पर बुरी नजर है, उनकी नजर के तुम तारा बनोगे। बस अच्छे काम करो, बस अच्छे काम करो, सदका दो, खैरात दो, बच्चे और बूढ़ों से प्यार करो और बुरी नजर से बचे रहो। अब इन सब के बाद भी अगर कोई नहीं मानता तो आपको क्या करना चाहिए, ये हम सबको क्या करना चाहिए कि अगर बुरी नजर वाला ना माने तो बस एक और आखिरी सलाह कि बुरी नजर वाले तुझे ही तेरी नजर लग जाए और बिल्ली तेरा रास्ता काट जाए। तो थैंक यू वेरी मच।
उन्मेष जी, श्रीमद् भागवत गीता का एक श्लोक याद आ गया हमारे शाहनवाज जी की शायरी के ऊपर। योगस्थ कुरु कर्माणि संगम त्यक्त्वा धनंजय। भगवान श्री कृष्ण बोलते हैं अर्जुन को, योगस्थ कुरु कर्माणि संगम त्यक्त्वा धनंजय, तुम अपना कर्म करते रहो, सिद्ध असिद्ध्यो समभृत्वा समत्वम योग उच्यते। तुम सिद्ध असिद्धो समभृत्वा यानी सफलता मिले या असफलता मिले, समत्वम योग उच्यते, अपना काम करते रहो। तो आप कोई बुरी नजर लगा रहा हो, कोई अच्छी नजर लगा रहा हो, उत्सन्न कुल धर्मानानम मनुष्यनानम जनार्दन नरके नियतम वासु भक्ति तीनों सुषमा। अपना काम करते रहो, उत्सन्न कुल धर्मानानम, अपना कुल, अपने आदर्शों को का पालन करते रहो।
करेक्ट।
अच्छी नजर बुरी नजर, देखो सब क्या होता है जब शाहनवाज साहब, जब हाथी चलता है तो पीछे मतलब द डॉग विल बार्क, he looks back and he says, oh, if I stop and just spend 1 minute you will be gone, but he continues. So ये अच्छी नजर बुरी नजर की परवाह ना करके बस आगे बढ़ते रहो। सिद्ध असिद्धो समभृत्वा समत्वम योग उच्यते। सफलता मिले या ना मिले, यही सबसे बड़ा योग। योग एक सिर्फ फिजिकल एक्सरसाइज नहीं है, इसमें जो श्रीमद् भागवत गीता के श्लोक में जो योग का वर्ड यूज हुआ है वो कर्म से जुड़ा हुआ है। समत्वम योग उच्यते, उससे बड़ा कोई कर्म नहीं। बहुत बहुत शुक्रिया शाहनवाज साहब, मजा आया आपके पोयम सुन के।
अरे कहाँ मोबिन भाई, बस थोड़ी बहुत तुक बंदी। थैंक यू वेरी मच, आपने मुझे अच्छा बताया। मैं
थैंक यू वेरी मच मोबिन जी। एक दो लाइनें पेश करता हूँ। एक उम्र चाहिए गालिब फिर इश्क करने के लिए, एक उम्र चाहिए गालिब फिर इश्क करने के लिए, क्योंकि शब्दों का हमारे उसने बीमा कर रखा है।
क्या बात है, क्या बात है। मतलब बीमे पे ही लिखेंगे आज आप। तो आपका आइडिया बड़ा अच्छा लगा कि मतलब ये प्यार का भी इंश्योरेंस होना चाहिए और इंश्योरेंस कंपनी को पॉलिसी देना चाहिए। जेम्स साहब, you should also share with us how this will be accounted for, the chances of claims and everything. And if suppose it goes wrong, then the insurance company should reimburse the policy amount.
Thank you.
Thank you, sir. Thank you very much. All